Let me now bring on board Ajay Srivastava, Chief Executive Officer with Dimensional Consulting. Ajay, good morning. Thank you for joining us. Ajay, I'll give you the options. What do you want to start with? A call on the index, why global markets are outperforming, or the fact that Infosys finally has acquired a small company?
Well, of course, it's the Infosys. Come on, that's the news people are waiting for. How many? 20 years now. So that's quite a thing. And I think it's important to learn that the management is responding. I hope it's not diversion of criticism more than a genuine acquisition, which I hope not. And if they're on this path, I think things should look good for Infosys. We have been running it down for a while. And I think for the first time we say good luck to you guys.
I just saw good traction on Friday. It continued into Saturday as well. Whatever was there in the truncated session, at least the headline number managed to close at 5350. And it's all been thanks to the global rally. How long would the global rally last, considering it's just the ECB stimulus which has given a leg up to the equities?
See, as you all say, till the printing machine is on, enjoy the ride. I think that's the bottom line, and we know that printing machines are not going to stop. But, one of the important things which came out in the last 2 months, more than just the global stimulus, is the fact that the whole scare being created by institutions like CI, etc., that foreign investors don't want to come to the country, GAR is an issue, we have been, kind of a pariah in the world market. That's been put to rest. Capital is flowing in abundant quantities into the country. Even when our own institutions are selling out, FIs are buying. What more proof do you want that the whole charade of that investors are scared to come into the market? Yeah, there may be pockets of people who have a different opinion, but the fact is capital is flowing to India as going to other countries, but much more to us. So that part of the scare, I think, should be put to rest. Well, global stimulus, we all know that we're waiting for this week for the Fed to come in, but most likely Fed will announce a stimulus because they've been telling us, and all the news tell us, that it's synchronized activity of the central banks, so we shouldn't be surprised on the downside.
This is not the Ajay we met last time. Last time when we spoke to you, you were careful, you were cautious.
See, I'm still very careful, I'm cautious. My allocations to equity market haven't gone up very much. I just say, enjoy the ride, you know when to get off. This is not a market to be a big fundamental investor in the economy, at least in India, for the time being is concerned. But yes, you don't want to sell off your portfolio because there is money to be made. Is there a case for contrarian investing into cyclicals? Perhaps answer is still no. We are facing downside. Select companies, big cap companies, yes. But small, mid cap, absolutely no. I think these companies will face far more downsides. So, this is going to be a very segregated market. Big companies with low debt equity ratios will continue to outperform the rest of the 3,000 companies in the market. So, I'm very cautious of 3,000, but at least 100, 200 companies, comfort is there.
And out of those 100, 200 companies, I'm sure you're only buying 3 or 4 stocks. So which are the 3 or 4 stocks out of those 100 companies you like your bank?
Why don't you say that, Nikunj, since you are the seer on the show? Why don't you say that? No, I think it's very important for us to, we agree that, banking sector, for instance, we moved holding and we continue to create position in like ICICI Bank. It went down to about 900. We picked up more. It's coming back to 940, 950s. Among the banking picks, we believe that's the best pick to have in the market in terms of pure share allocation of capital. In FMCG, I think you can just buy the top name and sit with it because in spite of at 540, Livers is at a PE or something like 25, a little over 25, and we should see a good result coming in. But don't go beyond too many companies because they will have a nasty result coming into September. So, yeah, select picks, you got Tata Global Beverages, you keep buying when it falls, so you keep holding the shares. So these are the kind of companies which you just keep building your portfolios.
Ajay, so what happens on the policy front? We've seen the parliament session come and go by and nothing really happened. Not even one session was actually conducted properly. The fuel price hike as well has been completely shelved. Do you think anything material is going to come about for liquidity to continue to pour into Indian equities?
See, I think, let's put it this way, that relatively speaking, capital will flow to various countries by virtue of portfolio allocation. If there is 10 billion of a 1 trillion coming into the market, we will get 10 billion or 5 billion of the allocation. 5 billion is a lot of money for this Indian market. So whether we like it or not, we may say policy paralysis, but the fact is the economy is still running around. We are still at 4, 5, 6% growth rate. What is the policy paralysis? We are looking at more administrative situations than policy. We don't expect too much from the government. We still need to consume our daily staples. Power is required, petrol is required. And I'm not in the school of theory which says diesel price hike is good. Demand is contracting in the system like nobody. I think people have to understand this. All the people who are saying increase the diesel price hike do not understand this, that at least by subsidy, it's an indirect funding. It's like a, it's like a stimulus. It's like a QE, simple stated. You increase the fuel price. What do? You take away the purchasing power from the consumer. Anywhere the demand is falling, consumer demand is falling month by month. So you're not going to do anything favors to the economy. So school of thought says increased diesel price is good for the stock market. Our view is that exactly the reverse. You increase diesel prices, demand will contract much more. You will see a dramatic fall in performance of companies. So our view is diesel price hike kept in abeyance for time being is good because we are seeing a severe demand contraction.
Can I challenge that, Ajay? Because if fuel price they go up, that will also take care of a fiscal, which means Reserve Bank of India will have ability to cut interest rates, and if they cut interest rates, indirectly it will benefit consumers.
See, okay, let me put it this way. If Nikunj, that's not correct, because whether the fuel price hike has not been given to the public or it comes by the fiscal deficit, the impact with the lag effect should technically be the same by and large. Fiscal deficit sometimes lead to inflation. We have seen that not happening in the US and Europe, which under recession, but the fact is in India it will happen. So inflation impact is negated, doesn't matter whether the people are paying the price or the government is funding by printing notes. So on a longer term basis, inflation impact is negated. The critical issue is, do the people have purchasing power? That's what QE US is all about. Bond purchases is all about saying that give the money to people to buy goods and services, which is what we want in India. We want people to buy discretionary products. We want people to spend money. Demand is contracting, so you're doing exactly the opposite. You're going to compress demand.
Ajay, my compliments on United Breweries, because you had, bought it for your clients and you advised our viewers to buy it. It was at what, 530? Now it is 620. Still time to hold on to United Breweries?
No, we have sold off our position. I think upward of 650. We have liquidated all the position in breweries, and because it was a very healthy profit, and we didn't believe that anything more would come out of the Heineken situation coming into Singapore. So we've liquidated all the positions in United Breweries.
Which is the next United Breweries in making for you?
I wish we are looking at it. We are looking at it right now. The next United Breweries has been always gold for us, and gold has done wonders to us. So that's why I said portfolio allocation has not changed, Nikunj, very much. It's still on to asset-intensive real estate, gold, etc., rather than being on equities.
You mentioned that you also are buying Tata Global Beverages. What's the thinking behind this? A tea company which is now moving up the value chain, or a tea company which is moving into water?
See, we have been buying this from, I think, post about 102 is the first buying price of Tata Global Beverages. We haven't bought anything post 130s. I think we stopped buying it post 130s. I think the logic has been simple that more than the tea company, the Starbucks joint venture should give it a major fill-up in terms of valuation. It's seen a average 20% fill-up. We think the price should touch about closer to 200 by the time we're talking next year on this share, once the rollout starts. So there is more a play on the new initiative than the old business.
So Ajay, what is your sense on which way the index is headed? Do you think we're going to continue to be range bound with individual stocks, mainly defensives outperforming, or do you think there is significant upside awaiting us in the near term?
Of course, I believe to the school of theory that we will see upsides. I think the downside risks are limited to 4 to 5%. The upside we're talking of 10 to 20%. So the trade-off is in favor of the upside. And the reasoning is that at some stage of the cycle of the economy, I don't know when it will happen, today, tomorrow, we will see cyclicals moving up the ladder. We will see the resource companies, the production companies, the steel, aluminium, ferrous, non-ferrous, the whole bunch of stocks, infrastructure companies, which will kind of find a plateau and kind of move up. So that's a play that, the defensive are not going to fall very drastically. I don't think people are going to sell them off even if a market turns around drastically down or upwards. So one sector of the economy is fairly comfortable, pharma and consumer. So what happened to the other sector? The other sector is beaten down with only hopes of going up over the long term, or at least 1 year or so, compared to going down, which gives you the credence that the index should move northward rather than any dramatic move southward.
So Ajay, hypothetically, if engaging in a conversation exactly after 1 year, which end of the market do you think will be trading higher, will go nowhere, and which end of the market could be trading lower?
I think, okay, let me put it differently in the industry. I think the small caps and the lower sized mid caps will trade lower than what they are today, in my view. The medium-scale companies which have not got a competitive edge will go nowhere in a hurry. The large-cap companies will show returns of about 20 to 25% on the equity price.
So at the current juncture, where to your mind there is a bubble, there is opportunity, and there is value in this market?
See, I think there is value in this market in select, say, private bank stocks. So when you see corrections, you kind of go buy it. I don't think I'm a buyer for the nationalized banks because I don't understand their financial reporting. I don't believe it for a minute. So a lot of cases are made of this arbitrage that they are quoting at PE of 0.7. Maybe they have a book value of 0.7. Maybe they should be at book value of 0.2 perhaps. I don't know the answer. I don't understand the financials. So I don't buy anything in nationalized bank space. In the private bank space, you will get opportunities to pick up an HDFC bank on an odd correction day, ICICI bank, and you build a portfolio for 25% return. Then you go to the FMCG stock. They do face corrections off and on. I would not recommend buying a Nestle at this stage because it's running at a huge PE of 45, 50 plus with some issues on costing and margins. But certainly in HUL, if in a dip day, buy it. I would not recommend buying Titan, for instance. I think Titan in next 1 year is a classic case which will go nowhere as a share, given the way the demand and the situation for the company is. So you got to pick, every sector will have its losers and haggard, and you got to figure it out which one is going to win the game. So like FMCG we said, Titan I don't think will win the game. HUL will win the game. In pharma says Cipla quoting at a PE of 15 today and showing a 25% growth in EPS is a live candidate to win the game in the next 1 year. Maybe some other pharma shares will not go up as much as Cipla will do in the meantime. So every sector will find 2 or 3 such players which will give 25% return.
Sajay, how would you dissect the auto space, given that while we have seen a trend of slowing monthly sales numbers, each of them is dealing with problems of its own?
The auto space, you got to figure it out that are you in the two-wheeler space or the ancillary space or Maruti or Mahindras and Tata. I think there are 6 stocks to talk about in the share. Auto ancillaries I would keep away for the time being because whatever, by the time the downstream impact happens, let us see. They already run up quite a bit in the last 1 to 2 months. So one must understand the run-up has taken place already. Now in the big cap stocks, Mahindra's story is rested upon the diesel engine driven SUVs, really speaking. Tractors not going to do well, SUVs. Now whether they can get their act together on all other products and acquisition, one doesn't know, but a strong track record, so one would not tend to short it, if not buy it at 780s or thereabouts. Tata is a good interesting play at 245. You're in the zone where you can make money but not lose too much of money. Two-wheelers, I think, is a general avoid, and if you really have to buy something, just go buy Bajaj Auto, because I think Hero will have trouble going forward in the next 12 months.
Ajay, I just want to spend some more time with you discussing private banks. Do you think last week's Morgan Stanley report on Axis Bank is an eye-opener, and the fact that it is too naive to assume that private banks will be insulated to an economic downturn? Because private banks also, they have exposure to infra. Some private banks also have exposure to private players which are, indirectly producing power.
Okay, my issue is this one. Axis anyway particularly I don't like for various other reasons, but that's apart. The issue is the private banks have greater flexibility to take decisions on the restructuring plans of the companies which are concerned compared to nationalized banks. I will tell you, we are seeing restructuring proposals. Second time CDR recommended by nationalized bank for a company which hasn't paid a single rupee of debt in 10 years. Now, would you recommend that proposal to banks to even consider it? That's the problem. I don't think a private sector bank would take the proposal forward to consider a 10-year non-repayment track record into a second CDR. National Bank would do. Yes, problems would be there, but the issue is that they are far more flexible to take decisions. They're willing to take the hits on the balance sheet and move on with life. Number 3 is, I think their security profile is far better than what relatively the nationalized bank. So I don't necessarily agree with the report that it's kind of what the specifics of the report are. But the fact is they will be far more flexible, therefore they will get out of sticky situations much better than the nationalized bank. So relatively speaking, we are better off with these banks because of the pure flexibility. And number 2, of course, is the portfolio is a lot better. It's not as bad as the thing. You look at the NPAs, you look at the provisioning norms, we are pretty robust on that. So I would still say the case is that they will come out much, much better and they're well capitalized to take the hit.